I don't need a tool for this. Let me just write it directly. $0. Not negative, not positive, just gone. Marcus stares at the number and it doesn't move no matter how many times he refreshes the app. Rent is due in 4 days. He has a job. He works 40 hours a week stocking shelves at a hardware store in Tulsa, and he has $0 because the last paycheck went to a car repair, and the one before that went to his daughter's asthma medication, and somewhere in that math there was never a version where anything got saved. He walks into the bank on a Tuesday to ask about a fee that ate his last $11. The woman behind the counter is polite, professionally polite, the kind of polite that has no temperature to it. She types, she waits, she tells him the fee is standard and can't be waived. He nods like he expected that answer, because he did. He leaves without arguing, because arguing costs energy he doesn't have room for today. Here's what nobody explains to Marcus, and what nobody explained to me either the first time I was in his exact position. That fee isn't random. It's not the bank being cruel for sport. It's underwriting math. Every account gets scored on projected profitability, average balance, deposit consistency, product usage, and Marcus, at this moment, scores low. Low-scoring accounts get fees because fees are the only revenue the bank can extract from someone who isn't carrying a balance they can lend against. This is the first thing you need to understand about how money moves through institutions. You are never being judged on your character. You are being judged on your data. 18 months later, Marcus has $1,100 sitting in his checking account, not because he got a raise, because he picked up a second job on weekends delivering auto parts, and instead of spending the extra income, he let it sit. He didn't know why he was doing it, it just felt safer than spending it.
The fee that used to hit his account every month quietly stops. Nobody tells him it stopped. He notices it 3 cycles later, going back through statements, confused, thinking maybe he misread something. He didn't misread anything. The bank's system flagged his balance crossing an internal threshold and auto-waived the fee because at $1,100, keeping his money in-house started to matter more than squeezing $11 out of him. This is the part most people never get told, so I'll say it plainly. Banks don't make meaningful money on fees. Fees are a nuisance tax on unprofitable customers. The real money is in float, the bank taking your deposits and lending them out at a spread. Your $1,100 sitting there is now inventory, and inventory gets treated better than debt. A pre-approved credit card offer arrives in the mail. Real limit, real terms, nothing secured. Marcus almost throws it away, assuming it's the same kind of trap the last offer was, the one that wanted $300 up front just to open account with a $300 limit. He checks. It's not a trap this time. It's a real line of credit, unsecured, because his balance history now says something different about him than it did 18 months ago. He takes his daughter to a birthday party for a kid from her class. The parents there talk about a lake house, about a boat they're thinking of upgrading, about a trip to Cabo they're planning for spring break. Marcus says nothing about his weekend job. He laughs at the right moments and drives home quiet. This is the part of a story that never gets said out loud in these videos, so I'll say it. The comparison Marcus is making in that room is almost useless to him. Those parents might be leveraged to the ceiling on that boat and that lake house. Net worth and lifestyle are not the same measurement, and the gap between how rich someone looks and how rich someone is where an enormous number of American households quietly go broke trying to keep up with a picture that isn't even real. 4 years pass. Marcus is 34 now. He and his wife have built the delivery side hustle into a 2-truck operation. Still small, still exhausting, but it throws off real numbers. Their combined accounts sit around $31,000, and for the first time, a banker calls him. Not a recording, a person named Priya, who introduces herself as his relationship manager and asks when he'd like to schedule 15 minutes to talk about his goals. Marcus almost laughs at the phrase, his goals. Nobody has asked him that in a bank in his entire life. He takes the call anyway. Priya explains something he'd never heard framed this way before, that the $1,100 he'd been letting sit in checking for years, earning nothing, could have been in a high-yield account this whole time, earning 4 times what checking pays, with 0 additional risk and 0 additional effort.
4 years of near zero interest on a balance that, compounded properly, could have quietly become several $100s extra a year, doing absolutely nothing except sitting in the right account instead of the wrong one.
This is the concept most people never learn until it's cost them thousands. Money has an opportunity cost, even when it's just sitting still. Cash isn't neutral. Every dollar parked in a low-yield account is a dollar silently losing ground to what it could have been earning elsewhere. It's not dramatic. It's not a single mistake like an overdraft fee. It's a slow leak, and slow leaks are the ones nobody notices until someone points them out. Marcus moves the savings. It's a 2-minute phone call. Priya does it while they're still talking. Skip forward again. Marcus is 41. The 2 trucks became a small regional logistics contract, 6 employees, and a net worth. After the business, after the house, after 2 mediocre years and 1 incredible one that crosses $2 million. He gets invited to something called a client appreciation dinner. 8 people, no pitch, no slideshow. Somebody from the wealth side of the bank asks him genuinely what he thinks is going to happen to regional trucking rates next year. Not to sell him something, because his answer is actually useful to them now. He drives home that night thinking about the bank branch he used to stand in 18 years ago, the one with the fee he couldn't get waived, and he realizes something that took him 2 decades to see clearly. The bank never changed how it saw him. He changed what there was to see. The system was never rooting for him and never against him. It was reading a signal, the same signal, every single time. Can this account produce value, or does it just cost us to hold? And every tier of treatment he ever received, warm or cold, was just that same question answered differently. Here's the part that matters more than Marcus's story. That signal isn't only read by banks. Landlords read it. Employers read it in a different form. Even the people at that birthday party, without realizing it, were reading it off him the whole time. In the car he drove, the clothes his daughter wore, the stories he didn't tell. Which means the real lesson underneath all of this was never really about banks. It's that most systems around you are quietly measuring the same handful of signals: consistency, reserves, and the ability to absorb a shock. And the fastest way to change how any system treats you is not to perform wealth for it, but to actually build the thing underneath the performance. A little more saved than last year, a little more consistent than last month, positioned in the right accounts instead of the convenient ones. Marcus at $0 and Marcus at $2 million were the same man asking the same question at every bank counter he ever stood at. The only thing that changed was the answer. If you want the next one of these, the version of this same story from the other side, how landlords run this exact scoring system on tenants without ever saying so, that one's coming. Stick around for it.